Good morning, ladies and gentlemen. This is Brad Matheny. Today is November 15th. There has been a lot of talk of doom and gloom lately. I'm seeing quite a bit of people out there saying that they expect the global markets to roll over and enter a deep, deep decline based on what's going on with the Fed and the fact that we've seen these excess bubbles take place. And I really don't agree with it. And I want to try to talk to you about this for the simple reason that I see it totally differently for a number of factors. But first, let's talk about the FTX collapse, the crypto collapse, what's actually happening with that, and how we can try to interpret the next phase of opportunity in the market. So let me start off by talking to you about what would, in my opinion, what would cause a global market collapse. The Fed would not likely cause a global market collapse. It could cause a number of at-risk countries to enter into some sort of a debt default if they're really severely at risk, have no raw commodities, and have really struggled with their excess credit and debt. But more than likely, they would end up just like Puerto Rico or Greece and enter into some sort of a default process where their debt would be forgiven or washed away or eliminated in some way, shape, or form, and they would restructure. Or they would, essentially just default, form a new government, form a new currency, and start over. So again, with these smaller countries, you figure at-risk third world, fourth world countries that may have issues. Is that big enough to cause a global market collapse in the U.S. and major markets? Well, ask yourself, did Puerto Rico cause a problem? Not really. Did Greece cause a problem? Slightly, because it was the start of the European Union. And it happened at a time where the markets were fairly fragile, if I remember right, 2010, 11, 12. But now, would a series of these types of events present some sort of a global risk to the U.S. stock market or the Japanese stock market or the Chinese stock market? It would present, ongoing capital risks in the terms of maybe a couple $100 billion, maybe a trillion or so, but not in essence of, say, 30, 40, 50 trillion, which is what I think would be necessary to see some sort of a massive global market collapse. So understand that the Fed and the raising of interest rates and the depreciation of assets, as well as demand in certain cycles, really is not enough to disrupt and present a massive collapse event. And I'll explain again to you why. I've gone through the three major cycles. You've either got to have war, you've got to have a massive global population collapse, or, and I say war, I mean global war, like throughout the world, a global population collapse of 20 to 30%, maybe 2 to 3 billion people die of something, disease, war, what have you. Or you've got to have something massive in terms of a financial collapse, which I would imagine would be somewhere between minimum 25 to, say, 50 trillion, like the derivatives market collapses, or Europe collapses, which would be, basically a third of the world's largest economies. That type of thing could send the world into some sort of a turmoil. And that type of thing would normally be associated with some sort of a conflict or war or what have you. Otherwise, I think we're going to have isolated events. And I think these isolated events are going to be containable, manageable, kind of like Greece or kind of like Puerto Rico. So now, the one thing that all these doom and gloomers fail to realize is that the globe over the past 50 years has printed trillions of dollars that are now out in circulation, supporting assets, supporting the stock market, supporting consumers. Now, why have we needed to do this? Because we have grown from 3.5 billion people to nearly 8 billion people over the last 60 or 70 years. We've seen a massive population growth. So even though population has increased by probably 60, 65% over the last 60 or 70 years, the actual money supply has grown exponentially compared to the population. Imagine population's grown by, say, 2.5 times, whereas money supply has grown by, say, 15 or 20 times. Why is this important? it's important to understand because a certain amount of money is removed out of the economy, moved into longer term investment, moved into wealth creation devices, or moved into long term assets like homes and other things. So now where does that money go? It's being stored in a hard asset. It's no longer fluctuating around the global economy. It's being stored in a hard asset like a home or a commercial building or some sort of retirement account. It is in a retirement account, though, it is typically moving throughout the economy in ETFs or stocks or some form of an investment. But remember, a lot of it is tied up in investments that might be 10, 15, 20 years where it's anchored into some sort of a stock or a bond or what have you. So there is this attrition of money where if we create 10x the amount of money over that same time frame, 20 to 25, maybe 30% of that money is moved into long-term anchored investment or hard assets. It's actually taken away from circulating day to day in the economy. So now that's something I want to focus on. And what I'm going to focus on is showing you how generationally we move through these cycles. So this is the Visual Capitalist, visualcapitalist.com. This is a net worth of age in America. And the purpose behind this is to show you, let me get this set up right, show you that we have a, that's fine. Let me go back down here. We have a younger than 35 all the way up to 75 and older. And what I want you to pay attention to is how the younger than 35 start out very low asset accumulation, very low net worth. Then we have this massive growth here in asset accumulation between the age of, say, 35 and 65. So call it 35 and, say, 75, because it really goes up to here. That's roughly a 40-year time frame. I consider that 2 generations. So someone that's, say, 30, starting out down here, would get to be about 50 right over here, and would get to be about 70 right over here. So this is a scenario where the 30-year-old starts to have kids. By the time they're 50, 55, their kids are having kids. And then by the time they get to be 65, 75, their kids are having grandkids. So this is the accumulation of wealth up until grandparent stage right in this area. And this is where wealth starts to distribute back to the younger generation to help them start to accumulate. So this is a cycle that takes place, almost like a plant. Starts out as a seed, it grows, and all of a sudden it starts flowering, starts generating its own clones, creating its own children, and then all of a sudden the assets of the plant itself, the core plant itself, start to diminish because it's reached an end of life cycle. So this wealth that's been accumulated starts to distribute back down into the younger generation to help them grow wealth. Eventually, through the death of this individual or couple, the wealth will translate or transfer back down here through an estate, through a distribution of an estate or retirement or inheritance. So understand that this cycle continues to move, and what happens is generally by the time someone reaches their 55, 60, they're helping their younger kids make it through the early stage to accumulate wealth. By the time they reach their 75, 80, they're in an end-of-life stage. They're living comfortably off of what they've got, hopefully. And now when they pass away, this wealth gets transferred back down here. Okay? And this cycle continues. But how does this work from a standpoint of what happened? So, for example, I'm a baby boomer. Okay? We have a whole series of Generation Z, Generation X, millennials. You have a whole generation of people that are coming up through this cycle that we're not paying attention to. And those that are right now in the, let's say, the under 50 crowd are in this early stage wealth accumulation, okay? They are going to continue to move through this cycle, build wealth, build opportunity, build technology, build industry, and build opportunities going forward. The people that are born over the last 10, 15 years, they're just entering into this phase over the next 20 years. So we need to take a look at where the real demographics are. Now let's take a look at this. This is Our World in Data, ourworldindata.org. And what I want you to pay attention to is what I was looking for is this graph. Now, I've taken this graph and I've drawn some things. So I'm going to move over to here and show you that in the 50s, 60s, and 70s, in fact, let me move to this one. This is the unaltered graph. So in the 50s, 60s, and 70s, you can see that we had a growth of very young kids after World War II. That's what this area is here. And this area is here. And it continued up into the 70s. Then we had a bit of a period where things stalled in the 80s. Okay, then by the 90s, it grew back out. And up here in 2018, we've stalled again. So what we're looking at here is this type of a growth phase, potentially outward. But look at the growth here. So we went from in the 60s, let's average here, 50s and 60s, we went young kids born, women here, roughly 39 million, and over here, roughly 43 million. Understand that we've had a very high growth rate of very young kids. By the time they reach their 35 years of age, over here, we're looking at 22, 23 million men, and we're looking at about 24 million women. So we went again from 30 million to 20-some million. What happened to those people? They passed away. Simply put, they just didn't make it through disease or accidents or genetics. Who the heck knows? But they just didn't make it, okay? And this is what happens as we start moving up the attrition ladder. As you start to move into higher age groups, you're going to find more and more people accumulating more and more wealth, but you're going to find a smaller group of people holding that wealth, okay? So what happens is every 30 to 40 years, we see a move. So think of it, if you were born in the 60s or graduated high school in the 60s, then you're going to follow this path as far as population growth, okay? When you get up here into the 55, 60, 65 age group, this is when you start distributing some of your wealth, typically, back down to the next generation. The next generation is going to be about 40 to 45 years behind you. So that's going to be back over here to the 90s and 2000s, which is going to come back down into this 25 to 45 range. So back over here. So these people up here in the 60, 70 area, in these darker blue areas, are distributing wealth back down into a very large group of people back out over here in the 80s and 90s, back over in this area, 2000s. When we get to 2000 and they get up into the 80, 90 year range, they're going to be distributing wealth out into the 2040, 2050 area back over here. And this is where wealth continues to accumulate and attribute over time. The wealth moves from the extreme consolidation period over this. In other words, we've got this consolidation of wealth up in this upper area, and it distributes way down here into these lower areas into broader scopes of people. So now, if I were to come over here and try to highlight this, the wealth that accumulated in this group, this inner box here, in the 50s and the 60s, consolidated into this group of people here in the, and this would be in the 80s and 90s and 2000s. That would put them from the roughly 15 to 30-year-old range up into the 45 to 60-year-old range up here. So from the 50s and 60s, they would end up moving up into this area in the 1990s, 80s, 90s, and 2000s. And up in here, this would be the early 2000s. This would put them into a point where they would be transferring wealth back down into these larger boxes, these outer boxes here, as these kids were born in the 70s, 80s, and 90s, or graduated high school in the 70s, 80s, and 90s. The same thing happens here. As this group consolidates and moves up, they are now going to be moving wealth back out into these yellow groups, which is the future groups. And as we move higher on up, the same thing happens. You get the group of elderly here that pass away. They move wealth back down into these median groups, and then back down into these lower groups as grandkids. And this is how the wealth cycle works. You're born, your parents take care of you. When you reach 15, 18, 20, 25, you start working, you start accumulating wealth, you get married, you start accumulating more. Your parents help you through the process. They make sure that you're solid. At this point, you have your own kids. They're graduating high school. They're starting to go to college. They're maybe getting married. And now you start moving into the grandparent stage. You've accumulated wealth, and you want to make sure that everybody's doing well. So you start transferring your wealth back down into these lower generations. But look at how narrow this was, the blue lines. Let me go back over here. Look at how narrow these blue areas were up in the 40, 50, 60-year-old range. Look at how tight this is compared to where we are in 2018. In that same area, we've gone from, 14 million and maybe 14, 15 million men and women generally, all the way out here to 44 million and all the way out here, almost 50 million women. So understand that we've gone from a 1950s, 60s time frame to 2018 in a 60-year time frame. We've gone to 5 and 6 times the total number of people that are out there. Okay, consider that for a moment. By the time you reach 60, okay, if you were born in this 2018 time frame or graduated high school in this 2018 time frame, there's going to be 40 to 50 million men and women on this planet, totaling 90 million. This is in the world population, and I got to say this. Distribution, sex, population division until 2010, showing the age distribution of world population, 70 years. So this has got to be, I would imagine, per country, because there's 8 billion people on the planet now. But consider this as well. So the wealth accumulation here was fairly small. Money has increased by more than, say, 10 to 12 times, so 1,000 to 1,200%. But the total number of people in the actual age group, in these younger age groups, once we get past 1990, has accumulated massively. So what's going to happen is as we transfer wealth, remember, the transfer happens in these areas. Now, I've drawn these as like lungs, okay? They happen in these areas. When you're 40, 50, 60 years of age, you start transferring wealth out to the next group. And you do that to try to help your kids stay alive and build wealth and be successful. When you get up into the 70, 80, 90-year-old, you've accumulated what wealth you have. It may be long-term investments, retirement accounts, what have you, and you start moving that wealth down to your kids or your grandkids through your passing or through your end-of-life process, through a trust, what have you. So it's really a two-stage process. Actually 3 when you consider infancy, and I will get down to that. So at this age, you move your wealth down to your kids, which will be down in this area. And at that point, these kids, so grandparents move their wealth down to the 50, 60, 70-year-old kids. These people then move their wealth down into the 30, 20, 30, 40-year-old kids. And then these people take what they want and they move their wealth down into supporting their younger children, 8, 10, 12, 15, 20. And this is the wealth effect. It trickles down. So from here, the 3 or 4 kids or 5 kids would get a portion of this person's wealth, and maybe the grandkids get a small portion. Then these people continue the wealth effect, trying to support these people, which in turn try to support these people. And this is all in the age group down here. But I want to highlight how this wealth effect balloons. So remember, if you follow the wealth effect here from the 60s, 70s, and 80s, and 90s, you see how narrow this range was? Very, very narrow. Okay, you had a very small number of people pushing this wealth effect out. Once we get up here in the 2010s, 20s, and 30s, you have a very wide wealth effect up here in the 70s and 80s. And that's coming. That's what's coming over the next 20 or 30 years. This entire wealth effect is going to balloon up, and it's going to transition into a broad base of extremely well-off, much more well-off than we had in the 60s and the 70s when we were still dealing with moderate growth issues after World War II. This wealth effect is going to grow considerably over the next 30, 40 plus years and get even bigger up into the 2050s. So understand that once we get up here into this 2050 range, and then that means you're born or graduated high school in 2050, When those people reach their 70, 80, 90-year-old time frame, they're going to be moving their wealth effect out across a very broad scope. And I tried to draw that out here. So by the time we get into the 2050 range and they're into this retirement phase, they're going to be moving their wealth out across this many people, close to 60 million men and close to 58 million women. And then that's in the 50 to 60, call it 45 to 60-year-old time frame. When you start talking about their grandkids, you're going to be moving out across close to 75 million men and close to 69, maybe 70 million women. You're going to have a very broad wealth effect compared to where we were, whereas in the 50s and 60s, when we reached this level, we were expanding across 15 to 20 million men and 20 or 19 to 24 million women in the 40 to 50 range, 40 to 55 range, versus 45 to, well, let's call it 33 to 45 million men versus 31 to 43 million women in the 20, call it 20 to 35 range. It's a massive difference. You're talking about potentially 2 to 3 times additional wealth distribution over the next 15 years to 25 years, which is taking place right now. That's the thing you don't understand. All of this accumulation, everything up in this area, from this area all the way up, is already transferring wealth. So remember, the baby boomers back down over here, 1950, give you an example. These guys are already old. They're up in their 70s and their 80s right now, and they're already transferring wealth back down. Okay, the next generation is going to be the end-stage baby boomers, and I guess you would call the Generation Y, which is the people born, say, 65 to 85. They're going to be the next group that comes up into here and starts transferring the wealth down. And then the next group will be from 85 to 2005, and that'll be roughly 2050. They're going to be the ones that start to accumulate wealth up here and start to transfer back out into this area. So we really only have about 15, 20 years for us to have moved from these areas in the 90s, out in this area here and this area here, to move out into this area here and this area here. All of this wealth effect is going to grow from essentially, let's call it 33 million to 31 to 33 million, all the way out to 65 to 70 million, and let's call it out here 64 to 70 million. So you're going to be looking at a 3x increase in wealth distribution and wealth accumulation over the next 15 to 25 years. Now, how is that going to play out with regards to doom and gloomers? You really want to know? This is how it kind of works. The 60s, the 50s distribute out to the 70s and the 80s. The 70s distribute out to the 80s and the 90s. The 90s and 80s distribute out to the 2000s and 2010s. And then, of course, the 2000 and 2010s distribute out to the 2050s and 40s. This is how it kind of works. So there's this massive wealth increase, and what happens is through each time the wealth distributes, there's essentially a 15 or 20 year growth period. So imagine what happens to money. The economy builds, house prices go up, stock prices go up, new industry is built, new hot speculative phases are built. What ends up happening is this money, which accumulated and grew in its time, gets put to use back down here, and there's normally a 2x to 3x growth factor of wealth. So imagine if this was 100 grand, this would be 300, 400 grand, this would be $1.3 million, maybe $1.5 million, $2 million. This would be 6 million to 8 million. That's typically how it works. Okay? So when we come right down to the long-term structure of wealth and where these doom and gloomers are talking about, and I love these charts where there's some massive red arrow that's like this, pointing straight down to 0, and it's like, oh, look, we're going to see a massive decline, and I'm trying to set this up real quick. a massive decline in price. Right in type. Let's use this one. You get some big arrow like this pointing straight down, highlighting the fact that, oh, the markets are going to collapse. There's nothing supporting it. It's all a big sham. Well, I'm going to tell you right now, you've got 8 billion people on this planet, a lot of them in already developed nations, a lot of them accumulating wealth on their own with jobs and education and wealth and investment. But you also have, hundreds of millions of people in the U.S. and Europe and the developed nations alone that have accumulated wealth, that are protecting their wealth, and that intend to pass that wealth down to their children so that they can do well. So what makes you think that this is going to happen on its own unless there's some sort of a catalyst event taking place? What would that catalyst event be? Global world war of massive scale, decreased population by at least 25 to 30%, and or some sort of a massive financial collapse. And when I say massive financial collapse, it would have to be in the scope of 25 to 50 trillion would have to happen. Some unraveling of a global financial crisis would take place to unravel this type of cycle. Now, let's talk about what I think is going to happen in 2028 and 2029. So let me come out here to 2028, 2029, 2026. We're not quite there yet. So I believe that when we get out here to 2028 and 2029, so I'll draw it here, vertical line, that we may see some type of massive cycle change moving into a downturn. So long and short of it, ladies and gentlemen, I believe we're very close to a bottom. We could still see a bit more of a washout, but we are, in my opinion, we're not going to see this deep, deep collapse. What we are going to see is some sort of a moderate upward cycle, maybe getting above these historic trend channels, and then some sort of a rotational stalling. Okay, at this point near 2028, 2029, we are likely to see some sort of a rotational downward cycle, maybe coming back down into these historical trend lines, down into these areas, and that would potentially represent from these upper levels down to here. I'm guessing this is going to end up being a percentage of about 31%. Yeah, well, 29.9. Okay, a 29.9% potential collapse, which would be very similar to what we had back over here, from here to roughly here. See if I got it. I did. Yep, a 29.69, 29.96. So this would be the range of the collapse potentially. We would be looking at something kind of along this line before we tried to find some sort of a base or a bottom. And it may take as much as 5 to 10 years to form that base or bottom. Understand that this could be a very sharp bottom. It could be a very extended, consolidated bottom. And what happens here is, and I want to point it out again, just so you're aware, okay, let's take a look at this growth. So what happens here? Where do we have this massive growth, okay? We had massive growth in the younger generation all the way up to 1990. Then we have diminished growth over here through the next 70, 80, 100 years. In the younger population. We went from 40 million up to 60 million. Hypothetically, that's a 50% increase in 1990. And then from 1990 to 2100, which is 110 years, we go from 64 million to 70 million. We're only going up by about 8%. So what happens in 2029 that's so important? Okay. In 2029, we start to accumulate this decreased population growth in the younger crowd. We start to see a decreased population throughout the world. In other words, deaths start to outnumber births to some degree. We move from a 2 birth to family to like a 1.2 to 1.4 birth family. So it takes 2 people to make a baby. Right now, we're probably at the 2.0 to 2.1 range. We're going to move to a 1.2 to 1.6 range, maybe. And as long as that contraction in birth rates continues, or we see some sort of a demise of population, then what's going to happen is we're going to possibly see some sort of a contraction event, which could revalue the markets. Now, how bad is this? It's the same thing we just went through here. Percentage-wise, it's going to feel a lot more difficult because we might see the S&P move from 7,500, 8,000 down to 48, 44, 4,800. That's going to feel like a horrible move, but in reality, it's about 30 to 35%. We're going to possibly extend back out, possibly move down a little bit lower as we wash out excess values, and then we will establish some new growth factor moving forward, ideally, and that's going to be the next phase of our population. Remember, that will not be the 21st century anymore, ladies and gentlemen. That will be moving into the early 22nd century type of stipulation. This, in my opinion, is the washout of the 20th century, 19th and 20th century excesses. This is the beginning of the 21st and 22nd century new economy. So ideally, how can I explain this to you? We're still living through brick and mortar 1890s through 1950s type of economy. That's what we have right now. And we're struggling with the excesses of crypto and technology and really trying to secure our future effectively. This next phase back over here, which is 2030, right in this area, 2033 onward, is going to be really the beginning and the shift that's going to lead us into the 22nd century. So this is where we're at right now. Where we're going to go is probably up into this area, followed by some consolidation, followed by some unwinding of capital before we move into the 22nd century liftoff, which I may not be here for. Believe it or not, I'm hoping I'm going to be here for this, but this is why this is the best opportunity of your lifetime to follow me, to follow what's going on, and try to ignore the real, pardon my language, crap that's out there. Unless something massively disruptive takes place, the world is going to continue to function. We have to be aware of the size and the scope of what is taking place. The long and short of it is there's this wealth transfer that takes place that will continue to keep assets in long-term value, which would be assets like homes, raw commodities, hard assets, retirement accounts, financial systems. It's just a matter of, again, can we survive the at-risk derivatives, global market, excessive credit, debt creation that's taken place over the last 40 or 50 years? Can we survive that? Can we unwind that? Can we contain that beast into something where we can clip its wings, clip its claws, take its teeth away, and turn it into a friendly little fur ball? And if we can do that, then we will transition in this manner. Things like FTX and cryptos and Bitcoin are cool, but they need to be consolidated around proper regulation, proper security. Same thing with our banking system, same thing with our government, same thing with our bonds. We need to go through this process. We need to go through this process, which is a valuation consolidation, before we enter the next phase, which will be a real growth phase. All right, guys, I hope this helps, and I hope this puts things into perspective. The real opportunity is to trade when efficiently into these trends and be prepared for this moving forward. Again, follow my research, follow me on Twitter, go to MENT.com, sign up, create your account. I'm trying to keep you guys aware of what's really happening in the market and stay away from the fluff. All of these doom and gloomers and everybody else, really, they're reacting on emotion, and they don't see what's really happening to capital, and they don't understand how capital really works. Capital will stay here. The only thing that destroys capital is the end of civilization, the end of nations, and global war, because it destroys the foundation for capital, and capital must be rebuilt. That's how things work.